What finance options are available out there to customers where, again, with Carillion, you look at the payment trends, credit would not be recommended, but the contract is just too big to turn down. So what finance options would you recommend to cover and sustain the cash flow?
First of all, it's quite an interesting overlap here between credit insurance and credit and finance.
Okay, excellent.
But what I'll do is I'll go through the finance options first in a normal scenario.
Okay.
For any company wanting to raise finance, there are a number of different ways of doing it. The overdraft and the bank loan are the first two that immediately spring to mind. They're the traditional ones. Overdrafts are much harder to get now, require personal guarantees and so on. Bank loans are rigid. Right, you borrow and they're rigid. Although there are certain loans around at the moment that are more flexible, but again they have to be secured on whatever you can secure them on, which might mean the director's own assets. The beauty of invoice financing, why it's becoming the biggest form of finance, is because it is secured on the invoicing. Now obviously that's a movable asset, it can be various levels of security around that asset, and that's where we come on to Carillion and credit insurance, but I'll come back to that in a minute. Within invoice financing, it is the biggest form of finance now, and it's probably the good thing about invoice financing is you can grow the level of finance as your debtor book grows. So as your business grows and your debtors grow, the more you can borrow. So effectively, you've got £100,000 in your debtor book, or £1 million, you can draw down up to 80-90% of that, depending on the sector you're in. But those debtors have to be approved by the invoice financer.
Okay.
Now the different versions of invoice financing, there's factoring, which is not always had the best name, and that's the traditional one, and that's a product that was pushed by the banks many years ago. It's where they do the credit control for you and they own the whole ledger. It can work quite well for small companies dealing with perhaps blue chips, call centre to call centre chasing, but generally speaking I tend to feel that if you keep your credit control in-house or with people like yourselves who are genuine experts in it rather than the bank doing it, you're going to get better service.
Okay.
Then you have invoice discounting, which is the biggest form of credit invoice financing at the moment, and that's really financing on the invoices without them doing the credit control.
Excellent.
There are hybrids in between, but I won't go into those now, but they're the two main versions. The third version is single invoice discounting, right, which is where they will just invoice one particular invoice at a time, usually for high amounts. Now the rates you pay here will be higher per month, right?
Okay.
The main difference between that and invoice discounting and factoring is they tend to be non-contracts.
Okay.
When you go into an invoice discounting deal or factoring deal, you will sign a contract for a minimum period of time, which I can negotiate down to quite low with very short notice. It's very competitive out there. But single invoice discounting, you just have an invoice for £50,000 and say, I want to borrow against that, and that's that. All you pay against that is the fee. Now the key difference here, the key thing here, which is where I have to work with my clients to find out what they best need, is that single invoice is more expensive per item, and if you do it a few times a year, it can work out a lot more expensive than having a contract. So you've got to really think about planning your cash flow and what you're going to need it for. But you might prefer the flexibility and pay a bit more. So it's balancing off those factors.
Okay. So going back to Carillion, would invoice financing, as you've discussed, cover the eventuality of the debtor going bust?
Very interesting. In one word, no, not without credit insurance.
Okay.
Okay.
So this is where the overlap works.
Yeah, that's right. Now, if you're a contractor supplying to Carillion, and it was a reasonable proportion of your debtors, say over 30%, or 40%, which it could well be, then the invoice financer will probably say to you, we will not actually finance those invoices unless they're insured.
Okay.
You have a credit insurance contract, okay? I'm not sure that was the case. I'm not sure that was always the case, and it varies from lender to lender, and that's something I have to find out amongst my lenders. And but the higher proportion of the debtors, the more likely that is going to be the case.
Okay.
The reason they'll ask for that is two reasons really, or they might ask for it. One would be the sector, and construction is not obviously one of the better sectors for stability and credit. And the second will be the fact that it's they haven't had the best record in recent times with slow payments and so on and so forth, and the findings and so on. And so they're the two reasons they might ask for it. If it's another construction company with a very good record, you might get away with not having to insure it, but it does vary.
Okay.
If it's only a small proportion of your debtors, like 5%, then you wouldn't necessarily have to insure it. So it all gets a little bit complicated, but that's where a broker comes in and can negotiate between the three parties. And it often ends up negotiating between the credit insurer, the credit financer, and the actual party.
So you could actually have two of those mechanisms in place.
Yeah.
Credit insurance to cover the account going bust.
Yeah.
And finance to cover either one invoice if it happens to be a key account.
Yeah.
And it invariably may well be that the credit insurance covers the accounts that the finance doesn't cover.
The reason the credit insurance is required by the finance company is because effectively if you've got an invoice and they've lent you £80,000 against it, right, that invoice is going to be owned more or less by the invoice financer.
Okay.
So they're insuring their own debts at that point.
Okay.
Right.
Okay.
So that's the way it works.
Okay. So, what kind of industries and sectors would you recommend finance?
Finance, pretty well any sector, depends if you need it. I mean, the main people that need finance, I mean, there has been a bit of a myth in the past that it's usually people in trouble who go for this sort of finance. So that's complete. Very, very few of my clients are in that. I would say about 1 in 20 of my clients have actually been in that situation. It's more often used to expand. If you've got cash in the bank rather than debtors, that's effectively what you're doing. If you've got £100,000 worth of debtors and it's on 60 days, you're not going to have that cash for 60 days. If you've got it now, we've got a proportion of it now, then you've got that cash to buy and play with, with stock and expanding any which way you like. It's like having a cash injection.
Yeah.
The cost of it's a lot less than people think because there's about 60 lenders in the market now, and if they're competing against each other, it makes a lot of difference.
So, when you go and see a client, how do you assess which particular product and service, given what we've just discussed, is suitable for them?
That's a very interesting question, a good question as well. I believe in seeing clients, and I believe a lot of brokers tend to pass around phone numbers a little bit rather than actually go and sit down with a client and work out what they want, because perhaps because I'm not from a banking background, I work from an SME background and I know how it works. First of all, we've got to engage that client and gain their trust. But the second thing is the finance is not about what they need right now, it's what they need in 6 months to a year's time, or even further than that. So you sit down and you're discussing not just what their requirements are for that moment, but also in the future. But the other side of it as well is once you're around the table, you really do get the facts out in the open a lot more. And you build a relationship, over the phone or by email, things can be missed, and there can be a lack of understanding at times. So, and the invoice financers will meet the clients as well, but I believe in meeting the client first because I've got 50 invoice financers to really negotiate with. Some of them I use obviously for various reasons, and once I've met that client, I know who they're likely to engage with and who is likely to be able to provide what they need.
Thank you very much, Clive, for coming in today. Some fantastic advice there on finance, very informative and an education. For any of you that are interested in the products and services that Clive described in this video, please do give Master Collections a call on the telephone number that will appear at the end of this video.
Money.